Tim, we might start with you. Company results coming up. You'll be very busy over the next month. What are you expecting?
Indeed we will, Chris. As to what we're expecting, it's a little bit hard to tell at this stage. One thing that I think is worth noting is that the equity market has run pretty hard in the last year or more, and it's not unusual for the equity markets to anticipate an upturn in the economy and rise ahead of an uptick in economic performance and earnings. With the equity markets having done that, though, we really do need to see some earnings growth from a lot of the businesses that are listed now in order to justify the valuations or the prices that we're now seeing. And if we don't see some reasonably healthy earnings growth, then valuations will start to look stretched. As to what we're expecting, I think there are a couple of things at play. One is obviously the Australian dollar has been weakening. Commodity prices are off, although the iron ore price seems to be holding at a much stronger level than people expected. That will mean that some of the big miners should be doing reasonably well. Production is going up. They've been focusing on costs, and there might be some good results there. Businesses that have or the benefit from a falling Aussie dollar should generally do well, particularly businesses that have a lot of offshore earnings and a cost base in Australia. Beyond that, it's hard to tell, obviously, what the big banks report will be important for the index. It's hard to see where they're going to get a lot of earnings per share growth. But if they don't, then the banks start to look expensive, so that will be interesting. Okay, excellent.
So what's your story on JB Hi-Fi? I must admit, look, I've been not in any of these retailers, but I actually have a few people that actually do own JB Hi-Fi. Are you in that, Tim?
Look, in the Montgomery Fund, we held JB Hi-Fi for some time, and we were fortunate to exit at close to the peak. With the share price falling back, we're taking renewed interest in it. It's a little bit of a tricky one, though. JB Hi-Fi has a wonderful track record of very, very strong economic performance, and it's on the back of that, it's the sort of business that is dear to our hearts. At the same time, structural change is obviously a bit of an issue. The increasing penetration of digital technology doesn't make it easy for someone like JB Hi-Fi. And the fact that Dick Smith is out there as a credible competitor doesn't make it easy, and we've seen some somewhat weak results from comparable businesses.
Has Dick Smith always been a credible competitor in that space? I thought they're doing bloody well, trading above the issue price. They've surprised me, but
I think they've always been a credible competitor, but Dick Smith has been somewhat ahead of them. I think, sorry, JB Hi-Fi has been somewhat
ahead of them.
I think Dick Smith are working very hard recently to lift their game. So for me, it looks to be somewhere around fair value, and if it continues to be a really good business that is able to get great returns on capital, then it's the sort of business you could happily own. Growth won't be, or the growth path ahead won't be as attractive as it has been in the past. They're now reaching a point where they're closer to maturity than they were, so the future growth will be more subdued. So I think it's a very good business, and I would have no problems with people investing in it at the moment. I think the share price has been knocked around a bit by recent talk about shorts.
Yes. It's always interesting when a major company comes out and says we expect everyone to go 20% short. I think that's not even a call. It's just
people may well have been doing that. It has historically been a popular one with shorts who haven't done that well shorting it recently, but perhaps they're having another go. Look, I think it's a good business. It's not overwhelmingly good value, but I'm happy for people to make a case to own it.
All right, Tim, $1,000 would lead to further carnage in the sector, I would have thought. Are you guys in anything?
We aren't in anything in gold at the moment. It's a challenging space at the best of times because it's enormously hard to work out what the price of gold should be, and if you don't know what the price of gold should be, you can't work out a valuation for these businesses. So we haven't been in anything gold related for quite some time. In relation to Red Mountain, it's not a business I've ever looked at before, but I'd note that it's an explorer rather than a producer. It's made losses in every year, including a $4 million loss in 2013. It's got a market cap of $14 million. It's really the sort of thing that it's not it's not what you'd call an investment. It's perhaps a lottery ticket, but it's the sort of lottery ticket that you're likely to lose on.
Yes, yeah. All right, look, I think that's fair enough. Tim, what do you think? I think Fortescue's actually got their quarterly out tomorrow, perhaps.
Okay, that might be right.
Yeah.
Look, I agree with a lot of what Ken was saying there. There's an interesting dynamic, I think, in iron ore, which is that everyone expects the price to fall quite significantly. They expected it to fall significantly last year, and they were wrong. They may well be wrong again, and if they are, a lot of these stocks will look really very cheap. And we actually have a very small position in an iron ore miner in the Montgomery Fund. We own a small stake in something called BC Iron, which is a very simple, low-cost iron ore miner. It has access to infrastructure, somewhat short mine life that they need to work on extending. But a very straightforward ore body that just they scoop it off the surface and ship it out there, and that's done very well over the last little while.
Yeah, it's up at $5 now in a report. Yeah,
there's a lot of risk there, and you would never want to have a big bet on it. But that dynamic where everyone's expecting something to happen and they don't really know what will happen means that there's some justification for having interest there.
All right, great. Thank you very much. Thanks for that, boys. Marianne, thank you for waiting on from Newcastle. How can we help you tonight?
Good evening, gentlemen. The company I'm inquiring about tonight is Big Air.
Yep.
Previously, David Buckland has had some positive comments to make on this company, and it has come back a little bit in share price, and I just wonder whether Tim thinks it's a nice opportunity to get into a good company at this stage.
Okay, no trouble. Listen, we'll go straight to Tim on that. Big Air.
Sure.
Yeah,
Marianne, we continue to like Big Air. We still own it in the Montgomery Fund. It's only a small cap stock. It's got a market capitalisation of 135 million, so it's a small position, but it's a business that has grown very, very well, and we think it's well run and has the potential to continue to grow well. The valuation is not compelling at the moment. We think it's probably worth around 73 cents. It's trading at 79 cents. But in the current market, there's not much that is trading at a discount to its underlying value. So at that ratio of price to value, we're happy to continue owning it. I think if it comes back further from there, then yes, that's probably a good opportunity to buy it.
All right, good stuff. Thanks for that, Tim. We're going to go straight to Abe from Sydney. Hi, Abe. How can we help you tonight?
Chris, for taking my call. I'd like to ask the panel's opinion about energy in general.
Yeah.
First of all, I mean, you hear conflicting opinions of people about the imminent oversupply coming from U.S. shale gas, and which particular type of energy, I mean, oil versus gas, is preferable. And also about oil search, does the panel believe that it's overvalued after its recent report, positive report?
Yeah, excellent. Thanks very much, Abe.
It's another case where you need to have a sense of what the commodity prices will be to have a sense of valuation.
We started with three really easy things for the show, haven't we?
And we struggle with that. So we're not doing much at all in the energy space at the moment. What the other observation I'd make is that for the big Australian energy businesses, Australia has become structurally a very expensive place to develop and operate resources. And the huge amounts of capex that are going into some of these projects seem destined to have a tough time earning the cost of capital. So we're not positively disposed to many of the large energy companies for that reason.
Yeah.
But it's an area where if you do have a firm view on what the supply and demand balance might be and what that might mean for the prices, then by all means back that. But we're not smart enough to do that.
I wish we all were. We wouldn't be here.
Right. I'm going to be really boring and completely agree with Ken. We own CSL. We own ResMed. We don't own Cochlear. We very much like CSL and ResMed, but Cochlear, it's been a great business for a long time, but it is very much a technology business. And what we've seen in recent years, or what seems to have been happening, is that the competitors have lifted their game very, very significantly in terms of their technology and have been taking market share away from Cochlear. If Cochlear can, with their new product suite, demonstrate that they are still very much the leader in the industry, then that will be grounds to look at them differently. But for the moment, we're out of Cochlear, and we're waiting for some reasons to get back in.
All right. And Timmy, it sounds like you guys owned them all. No?
Yeah, we have owned them for some time.
Right. Yep.
And don't disagree at all with what Ken is saying. The valuation is full.
Yep.
But it's a business that I think over time has the potential to grow very well. One of the things I like about it is that they've invested in the fibre network. Once you've got that asset, the marginal capital cost and operational cost of adding new customers to it is very, very low relative to the revenue. So as the business grows, the economics just get better and better, and you'll see the return on equity for Amcong just tracking upwards very nicely over time. We agree that it's pretty well managed, and there's clearly a tailwind in that the demand for data services is likely to increase rather than decrease.
Right.
So it's one that if you take a long-term view, I think happy to own it. It is a little bit expensive at the moment, and there are other telcos that are also very credible businesses trading on lower multiples. iiNet and I guess MTU. Being some examples, but Amcom, very, very good business. If you can take a long-term view, I think good one to own.
I think most of the panel has made some money on Sirtex, which has been a success in the sector. So maybe a little bit about that, and then tell us about Sirtex.
Sure. Wayne, Acrux, it's been a while since I've looked at this one, and my memory may fail me, but if I recall correctly, it's testosterone delivered via a patch or a gel. I may have completely the wrong company here. And when we looked at it, we sort of mapped out a DCF and couldn't get convinced on the valuation. But I see the price has come back a fair way recently. The automated valuation is telling me it looks like about fair value at the moment. But beyond that, I can't offer much insight.
You can always send an email, and we'll try to answer later. So maybe a bit on Sirtex.
Indeed. Sirtex is one that we own, and for those not familiar with it, it produces a product called Sirspheres, which is a microscopic radioactive sphere that's injected via the bloodstream into tumours in the liver. Delivers very, very selective radiotherapy to the tumour. It's delivered countless quarters of sales growth as the product gets better and better accepted by oncologists. The thing that's interesting about Sirtex is that they're investing very heavily in trials to prove up the efficacy of the product. There's some evidence that's out there, but not enough to persuade the market to wholesale adopt Sirtex, Sirspheres as a first line of treatment. We're expecting results out later this year, and if those results are good, then Sirtex is a business that stands to do very, very well over the years ahead.
Just sorry to cut you off, just briefly, it has done phenomenally well. It's up at $14. Are you just waiting around to see?
If the results are good, the addressable market for Sirtex could be 5 times the size of the current market.
Worthwhile still having a few.
There's a lot of upside still there if it goes well.
All right, thanks for that, Tim. Bill on the line from Victoria. How can we help you, Bill?
Well, I'm just curious as to what the panel's view would be on the chances of Lynas, LYC, ever picking up again from it's been around 30 cents for a month or so now, I guess.
Yes.
It's had a long fall from $2 plus.
Yeah.
And I'm just wondering whether the panel think there's any point in holding on to it. Any longer?
Yes, I think it's an excellent question, Bill. And I must admit, nobody's actually asked me about Lynas for the last couple of years that I can remember. And the brokers that had really strong buys on this with $5 and $6 targets a couple of years ago, luckily I can't remember who they were either, but the stock was well north of $2, was popular. Rare earths in Malaysia. I have no idea, and I don't think either of the other boys have much idea of what's happening there at the moment. But Tim, do you want the hospital pass to, you know?
Yeah, look, I think there is I guess, something to be sort of drawn out of the Lynas experience. If you look at broker forecasts for Lynas or its history, it's made losses for forever. It's expected to make a loss this year. Broker forecasts show it surging into profit in 2015 and then making a very healthy profit in...
I think they did 2 years ago as well, didn't they?
I just had a look at what those forecasts were exactly 2 years ago.
Right, okay. Well done.
The forecast 2 years ago today showed Lynas surging into profit in 2013, and that obviously didn't happen. And you see this a lot. Businesses that haven't ever made any money but are going to make money very, very soon. Fund managers, as a rule, just don't buy this sort of business, and I think that would be my advice to the viewers as well: is don't buy this sort of business.
Yeah, I think you handled that hospital pass well. Thanks, Tim. All right, what do you think, Tim?
Sure. Yeah, I had been a big fan of Reject Shop in the past. We owned it in the Montgomery Fund, and I was of the view that it was a very well managed business. The Montgomery Fund sold out of it some months ago, so we. Like Ken saw, I guess the prices starting to get a little bit high. And recently it's been hit very hard, and it was a confusing announcement, and it looks as though, or you don't get a lot of confidence in sort of management from reading the announcement. It looks like there were problems with the mix, just getting the basics of retailing not executed as well as they should have been. Having said that, with the price falling as far as it has, it does look like value now. We would put an intrinsic value of north of $12 on it. So with the share price closing at $11.10, it does look like there's long-term value in the stock now.
All right, excellent. And look, two stocks I brought up before because we get lots of emails about them, and that is REA and Seek, which were both up 3% again today. Either one of those, Tim?
Yeah, we also like Seek.
Yep.
We've owned it forever,
Yep.
and we think that the long-term story is very good, particularly in the international business as internet penetration increases. REA, I'm surprised that no one has got the guts to put a sell on REA.
Yeah. They may be out there, I just haven't seen one.
It's a great business. It just can't be worth $42 a share. It's just not. Even though it's a wonderful business, I think on valuation grounds it's very hard to get there. I agree with Ken. They've had a bad couple of quarters as a result of the introduction of competitive bidding. Our assessment is that the disruption caused by competitive bidding is a temporary issue. And that's the reason for some weakness in the last little while in the share price. The long-term story we think is very much intact. Valuation, we think it's probably worth 15% more than the current share price, and for a business of the quality of ResMed, that's a pretty good deal. So we think entry price is probably right here.
All right, okay. Thank you very much for that, boys, and I'm sorry we couldn't help that second last caller there, and unfortunately we didn't fit most of the callers in tonight. It was a busy night. Hopefully you can try again next Wednesday, or please send an email and we'll try to respond to you as soon as we can. Unfortunately, that's all we've got time for today, so thank you so much to our guests, Tim Kelley from the Montgomery Fund and Ken Bloomfield from Financial Clarity, and thanks to you, our viewers, for all of your calls and your emails. Until next time, I'm Chris Kimber. You can email me at chris@kimbercapital.com. Good evening.